Hi, everybody. I'm hoping I'm set up correctly. Just you should be able to see my screen on my slides. If not, please speak up. Okay. Uh, my name is John Lewis. I'm a research scientist at Upstart. It's definitely a pleasure to be here today. Thanks for inviting me. When thinking about this talk in this group and looking at some of the other talks, I thought it would be hopefully useful and interesting to just give an overview of AI lending at Upstart. Um, and so the goal here is just kind of give you another piece of information on like real world applications of machine learning and some of the unique issues we might face at a lending company, which could probably relate to your individual applications as well. So what I'll do is talk a little bit, it'll help to just give an intro to Upstart and what exactly we do, as well as talk about our product and from the perspective of an applicant and kind of what problems the machine learning team is trying to solve. Also, we'll talk a little bit deeper dive into Upstart's underwriting model, and then there'll be time for Q&A. All right, so what are we? Upstart is an AI lending platform. Our mission is to enable effortless credit based on true risk. We were founded in 2012, and since late last year, we've been a publicly traded company on NASDAQ. And we have two offices. The main or the office that's been around since the opening.
Someone's knocking on the door.
Is in California. Sorry about this. And we have an office in Columbus, Ohio. So let's begin with a little bit of a pop quiz to motivate the problem that we're solving. And one of the facts I'll give you here is that roughly half of Americans have access to prime credit. And the question is, what percentage of Americans have never defaulted on a credit product? And we sometimes do this through a Zoom poll, but if you just want to throw your answers in the chat, if I can find the chat. Okay, I see the chat. See one answer here, D. Anybody else? B, okay. All right, so a lot of different answers here. C, D.
Hey, baby.
Couple more seconds. All right, so the answer is actually D, 80%. So 4 in 5 Americans have never defaulted on a credit product, and so this has eye-opening implications. And the idea being that with smarter underwriting, we could approve almost twice as many people with fewer defaults. Okay, and so this is the problem that is the reason why Upstart can exist. Without this inefficiency, there's no problem for Upstart to solve. So going back to our mission, enabling effortless credit based off of true risk. So there's basically two aspects of this. I mean, the first aspect we could focus on is true risk. Our goal here is to accurately predict whether somebody will pay back their loan product. And we believe in order to do this well, we need a holistic picture of the borrower or the applicant. Traditional models tend to only focus on credit history, a small number of variables. And what this does is it is advantageous for those that have had an opportunity to build up a credit history, but it's not advantageous for those that are new to credit products and don't have a long history. And so our goal is to be more forward thinking, use what we sometimes refer to as non-traditional variables such as employment, education data to try to get a more of a holistic picture, or a picture of someone's potential, so to speak. The risk here doesn't just involve default risk. It also involves risk related to certain aspects of the borrower. For example, one thing we're always concerned about is fraudulent activity. All right, so someone can come and give us all this information, but if it's fraudulent, then the way we use that information is just it's not, we're pricing based off of fake data essentially, and it's not a true risk. Our risk is much higher in that case. And so we also need to be able to accurately assess whether somebody is a fraud risk. The effortless part, the second aspect of our mission, really goes into this idea that we want to make it as easy as possible for somebody to apply for a loan and get the money for that loan, right? So I mentioned this verification or fraud risk. Well, most people are telling the truth. I mean, this is a problem where most people are being truthful about their application. And so we don't want a lot of false positives here, because that increases friction for people. We also don't want a lot of false negatives. And so it's this classic false positive, false negative trade-off. And so given this, it shouldn't come as a surprise that machine learning is sort of at the heart of being able to accomplish this mission, right? We develop machine learning models to predict risk of default, of fraud, and we also work with the CFPB, which is the Consumer Financial Protection Bureau, to make sure our models are fair. So we have systematic fairness reporting that we report to the CFPB. So all this is involving the machine learning team. The effortless part, again, we have verification models. So the example I gave is fraud. We have models that predict the likelihood of fraud. And also another aspect of effortless that I haven't mentioned yet is in our marketing efforts. We want to be able to find the people that are in the market for a loan and make it as easy as possible for them to find us. And so machine learning is instrumental in our targeted marketing efforts. Okay. And if it's not clear, if you have any questions, feel free to stop me as I'm going through. So now that we have a little background of Upstart and kind of where machine learning fits in, the next thing I want to do is just walk you through our product flow from a perspective of an applicant. And as I'm doing this, I'll highlight the areas where work from machine learning comes in. Okay, so here's our landing page, and this is one of the main ways people can come and apply for a loan. They click check their rate, and then they will fill out some information. And this really is the start of the information we collect to predict their risk, right? And so we ask things, like you would expect, like who you are, right? But we also ask things like, what is your background? What is your job, occupation, education level, and so forth. If someone goes through this process and says check their rate, we take the information from the funding form, and we use that to pull third-party data such as credit history as well. And we do a lot of feature, and this is where our machine learning underwriting model comes into play. And in the background, the feature engineering pipelines and the model pipelines are working, and they make predictions on someone's default probabilities. these risks or default probabilities are used to determine someone's interest rate. And that is the price of the loan. If we can give an interest rate to somebody or approve a loan, essentially, we make them an offer, and sometimes they'll get more than one offer. And there, the applicant has a chance to accept or just stop the process. They also have a chance to change some characteristics of their loan, like the loan length and the loan amount. And then we'll reprice them if they ask. After they accept, we have two decisions to make, right, in terms of the risk of the borrower, right? We price them based off of the information we collected on their funding form. And so one option is just to essentially give them their money, right? They accepted the loan. Let's make it as easy as possible. This is their price. They'll give us their bank account information and we'll deposit the money. And there's some additional agreement forms. You'll pay us back this much every month and so forth. The other thing is we could ask them to verify information, right? And this is what, this actually adds friction, as I was talking about before. So some of the things we could ask for are, we couldn't quite automatically verify your income. Can you upload a pay stub from your job? And sometimes people have jobs, sort of non-traditional jobs, where we have to do more income verification, for example. Another thing we might want to verify is their education history. We do work with third-party vendors to verify these things automatically, but sometimes it just doesn't work. And so we're going to ask them to do that. The important thing to realize here is that this all causes friction. I would say that our system is pretty good, but we are continually trying to make it better. And that's where machine learning comes in a lot. And improving our verification models, because the more people we can instantly approve and just say, hey, great, you gave us your bank account, we approved you, you accepted, and here's your money. That's better for the borrower, right? And it's also better for us as long as we're accurate. Because if we send somebody to manual verification, the other option, our conversion rates drop quite a bit. Okay, so it's more friction for the borrower, and if we're wrong about it, we actually lose out on a customer in many cases. Post origination is another area where machine learning comes in. It's not just about pre-origination, but somebody is in the payment process and something unexpected happens, right? This happens as people run into hardships and they need some help getting back on track. So last summer, for example, during the heart of COVID, a lot of people were losing their jobs from a lot of different industries, right? And so I was involved in trying to develop hardship plans that targeted people in a way that was beneficial to the borrower as well as beneficial to Upstart. And so, we have several hardship plans, and one of the goals here is to find the people that would benefit from a hardship, basically a loan modification. So basically saying, hey, we will pause your payments for 2 months, for example, and then at the end of those 2 months, you can start paying again, and that'll give you time to get back on track. I think the main question here that ML is concerned about is, it is natural in lending that some people do end up defaulting. It is actually better for both Upstart and the customer if we can just if people are going to default no matter what, it's better that we just let them do it, right? Because it means that the borrower can start that process sooner, the sooner that they can get through that, hardship overall, and that defaulting, the sooner they can get on track later on in their life. But if we offer somebody a hardship that's going to our loan modification that's going to default anyway, then we've also lost money because we've forgiven more, right? So, but if we can identify the right people, it helps people understand that the hardships are there. Some people don't even know that these options are available, and it helps them get back on track. So it's sort of a win-win. Okay. Upstart its main product for most of our existence has been personal loans, and it's a really successful product. But as you might know, personal loans is not a very large market, especially when you compare it to auto loans. Most people in America have an auto loan at some point in their life, and so we do have an auto product that we just launched last year that we're really excited about. And it's the same sort of problem when it comes to underwriting. I would say the main difference is that this is a secured product. You know, from an underwriting perspective, the setup is basically the same. We give a loan, they pay us it's an installment loan, they pay us monthly, every month the same amount. And we're just trying to predict whether or not they're going to default on that loan. So the setup is essentially exactly the same in terms of predicting default. But the pricing is somewhat different because it's a secured loan, meaning that there's an asset that backs that loan. If somebody stops paying their loan, unfortunately, their car is repossessed, and that's an asset that we can get money back from. And so this tends to make secured loans cheaper overall. Their APRs are lower than personal loans. Okay. All right, so let's have an in-depth look at Upstart's personal loan underwriting model, and this is parenthetically a somewhat in-depth look, mostly because a lot of the details are of course proprietary, but we'll go into as much as we can. So what is the goal of underwriting? I've alluded to this, but it's basically to predict how likely a borrower is to pay us back on their loan. We have to answer the following question. Can we give somebody a loan? And if so, what is the interest rate on that loan? So a little bit of self-advertising here. Our results today are pretty staggering, I would say. This is an analysis done from the CFPB. Again, the CFPB is the Consumer Financial Protection Bureau. It's the main government agency that's in charge of consumer protections. And in their analysis, they found that Upstart's underwriting model approves 27% more borrowers than traditional models, traditional underwriters, and yields 16% lower average APRs. And so this is the main reason why we've been able to be so successful. And I think personally, we even have a long way to go, right? So back in 2014, 15, again, the company was founded in 2012. One of the challenges was we didn't have any data, right? We didn't have any of our own data on loans. Nowadays, we have a huge database of loans that we have originated. We know the monthly payment history of each one of those loans, and we have all the information on the borrower, all right? So we have a huge data set that we can train on. But back in 2014, this was not the case. So I wasn't here in 2014, but I know a lot of people that were. And so they tell me that it was basically a bunch of cobbled together data sources on loosely related problems. And they built models that were things like logistic regressions, and then made a bunch of assumptions and guesstimates to get the predictions. Apparently, they were pretty successful because we're still around, and that was sort of the core of what we did. But as we gathered more data, we started training on our own data that we've observed. When you have more data, you can do more complex modeling, less parametric assumptions. But our portfolio was still new, right? So one of the things to think about when modeling loan risk is the timing aspect. Our loans are 3-5 year loans, for example. Most of our loans in our portfolio have not seen that time frame, and so they're only partially observed. So there's still some rigid assumptions and rigid, mostly about timing of default. And then as we've continued to grow and collect more data and have more monthly observations, we're still training on our own data. We're predicting defaults as well as prepayments. This is another thing to think about when it comes to loans. Somebody a borrower can prepay their loan. There's no penalty to do that, but that affects cash flows and the expected investor return on that loan. So to clarify that a little bit, if an investor wants to invest $10,000 to give somebody a loan, but then that person pays them back in the first month, then they basically get their $10,000 back plus 1 month of interest, whereas they were expecting cash flows for 36 months and a certain return on those cash flows. So they're not actually meeting their return, and so the prepayments are sort of, they're good because the borrower paid us back, but we do have to keep track of them because they do affect the expected returns of the loans.
Real time or the
and then also with board data, we can have flexible timing assumptions. Before, when we weren't observing loans for very long, we say a 3-year loan, most of them we've only observed for say 6 months, we had to make rigid assumptions about what would happen in the following 30 months of that loan. Now with more data, we can make more flexible assumptions about that. Okay, so just like any machine learning model, or I guess ones with tabular data, we have inputs. You can think of these as n-dimensional vector corresponding to borrower's information at the time of submitting the loan application. The features here I've alluded to include things in the credit history, educational information, job information, digital signals as well. So, how many times that, just things that related to how they interacted with our website. And so we have in borrowers in total, for example. Each borrower is in basically one of 3 states in their loan. They've fully repaid their loan. That's good. And this could include somebody that has matured and paid on time every month, or it could be somebody who prepaid their loan. Defaulted, meaning at some point in their loan, they stopped paying. And then current, right? So they haven't matured, their loan hasn't matured, and they're still in the repayment process, but they're on time with their payments. So far, so good. And what this creates in our world is a lot of censored data. The main point of this slide is that we have a lot of, in statistical parlance, right censored data. And so you can imagine as we're observing a loan, if they haven't matured, but they're so far so good, we don't know exactly what's going to happen in the future, right? And so that's right censored. These events here would be either defaults or prepayments or mature, the loan matured. This bottom one here is we just don't know what's going to happen. Okay. also mentioned on the slide is that we care about the timing of default. So this is another aspect that we have to think about. If somebody defaults early on in their loan, that's much more costly than if somebody defaults or stops paying in like the last month of their loan. And the last month, we've just missed one monthly payment, but if they stop paying in the first or second month, we miss all the monthly payments going forward. So it's much more costly to default early. So it's important to get the timing of default right when we're doing predictions. So because we have this setup, we formulate our ML problem as a survival analysis problem. So we're interested in estimating the survival function and the hazard function. So the survival function is the probability that default does not occur before some time t. You can think of this as, say, month t of the loan. The hazard function, again, this is a default rate at time t or month t, conditional on survival until that time. And if anybody has experience with survival models, you're probably thinking about things like Cox proportional hazard models or things with strong parametric assumptions, Weibull models, or something like that. We try to extend this framework to be more flexible. We have lots of data, so we try not to make parametric assumptions on these hazard functions, or if you will, survival function. Okay, so we've got this setup of a survival problem. And one of the things the machine learning team is constantly trying to do is improve our model, just become better at predicting risk, becoming more accurate. Oh, I just saw back up here. Sorry about that. I just saw the question in the chat. So I can try to answer this. It says, while training the model, are you looking for first year of loan performance or 2 years or something else? Yeah, that's a really good question. So I would say that some traditional underwriting that I've seen will target things like probability of default in the first year or probability default in the second year. We're really looking at trying to predict the performance across the entire life of the loan. So if it's a 3-year loan, we want to predict performance on all 36 months of the loan. Now, what's alluded to in this question is sort of the cost of making errors at different parts of that timing curve, right? It's really important for us to get that so-called timing curve correct early on, because mistakes early on are more costly than mistakes later on. So I hope that answers your question. Just speak up if you have anything to follow. Okay. All right. So we're always trying to improve our model because we truly believe that being more accurate is better for the borrower. We can lower prices. We can approve more people. But we always have to keep in mind the relationship between improvements in our metrics, our machine learning metrics, and the business, right? Profitability and revenue. You can think of it as we could almost certainly build a model that only approves people that never default. And so our portfolio becomes everybody that just doesn't default. But then these people would just be the super prime people. They would never default, and our portfolio would be much, much smaller, right? And it wouldn't really adhere to our mission because we wouldn't be opening up credit to a lot of people. And so there is this kind of give and take. Our model can become slightly better at predicting, but it could approve fewer people. And so this is kind of the tug and pull that we deal with on a day-to-day basis. So other aspects that we deal with is predicting into the future. So probably a lot of people are probably familiar. I mean, we're training on data that was observed in the past. We're training on loans that were originated in the past. Credit performance is highly sensitive to changes in macroeconomic cycles. I mean, you know, the most obvious example that's still fresh in our minds is COVID-19, but other recessions as well. And the questions we have to answer is how can we adjust our model predictions to account for these sudden changes, right? We also are concerned with another sort of prediction or extrapolation of our predictions is not just in the future, but extending our customer base. A lot of our bank partners they set sort of boundaries on credit scores because they don't want to, lend to people outside of a certain credit box. But we're always trying to extend those credit boxes because it's part of our mission. So how do we predict accurately those with lower credit scores when our training data set doesn't have any of those types of people? So these are questions we're constantly thinking about and trying to solve. I also alluded to sample selection bias a little bit in the sense that our training data is all things that includes all funded borrowers, right? So we only observe loan performance on loans that we approve and fund. We don't actually observe performance on those that we approve and don't fund or those that we decline, right? So there's bias there. Production data or the data we see at production is much different than our training data. Our training data is filled with people we've approved in the past, right? But everybody that comes and applies, we don't know whether or not we're going to approve them. So it tends to be a riskier population. And so we need to correct for this selection bias accurately to flag those high risk applicants. Let's see. Just a few more aspects to talk about on what machine learning works on, and one of the ones that is I think inherently important is fairness. One major concern when you kind of let AI models do the grunt work is that they will reflect biases that are inherently part of the training data, right? And so for example, give different prices or lower prices to a certain class of people and higher prices to another class of people. But there is nothing inherently different about these people's true risk, right? It's just an inherent bias that the machine learning model is learning. One of the major challenges here is what does fairness mean in the context of our model? And there's a lot of research in the academic world, as well as what we do, that deals with fairness in AI. And the fact is there's no single definition of fairness. There are multiple definitions. And unfortunately, just by the axioms of probability, they're not all simultaneously achievable. We do work closely with regulators. I had mentioned the CFPB a couple of times. Again, this is a Consumer Financial Protection Bureau. It's a United States agency that is responsible for consumer protection and the financial sector. We work closely with them to design tests for our model and reporting. So we report to them on a quarterly basis about the performance of our model from a fairness standpoint. And we also have a different reporting every year. So quarterly reporting as well as yearly reporting. I linked Upstart's no action letter. And this no action letter is basically an agreement between Upstart and the CFPB to perform regular agreed upon tests on our model. So no action refers to the fact that the CFPB is not going to take any more regulatory action on us as long as we abide by the stipulations laid out in that letter. So a good portion, I would say, probably about 3 or 4 of us on the machine learning team dedicate a huge proportion of our time to running these tests and analyzing our models in the lens of fairness. Also related to fairness is interpretability. But interpretability also has an aspect that we must abide by from a regulatory standpoint. And it's this idea that when we cannot offer somebody a loan, we have to tell them why. And this is actually a challenging problem. We declined you. Why did we decline you? And when you have a complex machine learning model, it's not necessarily clear why we declined somebody. In more coarse underwriting procedures, it's almost always clear. Oh, your FICO score was below this, so we can't approve you. Your income was below this, your debt is too high. And so again, there's a lot of, I mentioned there's a lot of academic research in fairness. There's also a lot of academic research in explainable AI or being able to explain the outputs of quote unquote black box machine learning models. And so we use some of that work and develop some of our own to be able to tell customers why they got declined when they get declined. And these are actually called adverse action notices. And ideally, they will give a sentence or two about why we decline them, and it'll be an actionable change so that potential borrower can make actionable adjustments to hopefully be approved in the future. So the question that ML asks is, how do we generate adverse action notices from our complex machine learning models? All right. So yeah, so I hope that was an interesting overview of AI lending and some of the challenging problems that the ML team faces at Upstart every day. We are growing, we are hiring research scientists, data scientists, machine learning engineers, software engineers in both of our locations. And so I just thought I'd throw that out there. Please feel free to contact me or one of the recruiters on here if you have any questions about that. And here are our locations. This is a Columbus Data Science Meetup. So I was looking at some of the locations, but I assume most people are in the Columbus area. This is just High Street, 711 High Street, just east of Goodell Park. We're looking forward to getting back there soon. We've been, like most people, we've been working from home for more than a year now. But hopefully we'll get back to the office soon. Yeah, so that is all I have. Does anybody have any questions? Okay, there's one in the chat. Anshuman, do you want to say it out loud or should I just read it? Okay, the question is, does CFPB exercise oversight over the in-house fairness tests as well? Yes, absolutely. So the tests that we run were designed in collaboration, really close collaboration with CFPB. They have a team of statisticians and machine learning experts, and we do as well. And so we met regularly with them. So The first no action letter we had was in 2017. There was a set of tests, and we, over the course of those years, last few years, we've worked with them to improve those tests. And so I imagine over the course of this next iteration of the no action letter, we will continue to work with them to improve those tests. So yeah, they are agreed upon, and code is reviewed, and that is there's a whole system in place to run those tests.
I had a question. So, John, when you said, you model features and then you used to use that to train your model. So supposedly over time, you realize there are certain features that always stand out in accurately predicting on how much of a loan should we give to an X person on this interest rate. What if those features are missing for certain people? What do you do in those cases? I'm more of like missing data or missing features which are really important in predicting. How do you go about dealing with that? And then I have a follow-up question.
Yeah, that's an excellent question, and it's very relevant too. People's credit histories are often of different lengths, and sometimes the credit bureaus aren't. Yeah, so sometimes the data that we get back from the credit bureaus just has missing information. And I would say for the most part, we use boosted tree-based methods for the most part. And these can sort of naturally handle some missingness in the data. And so for the most part, we allow the model to try to find any signal that might be in the fact that variable is missing.
Right. Yeah. So a follow-up question to that is, say an X person has defaulted on his or her loan. So is there like a feedback model where your model goes back to increasing the interest rate for that specific person because he or she has acted in this way? Like, is there like a feedback loop to the machine learning model, or is it just like you give a grace period and you reach out to them?
Yeah. So that information, that particular person's payment history will be part of our training set. So the fact that they defaulted and at what time will be the information that's fed in when we retrain the model. And so the terms of that person's loan, that specific person's loan can't change because it was in the past, but in the future, that profile will be part of our training data set.
Right. Thank you.
Yeah. So the question is do you use in your model time of year as a feature to predict the outcome? Curious if it has a big impact. So what I'll say here is certain details of the features that we use, I'm not at liberty to talk about, and this feels like it's on the border. So I'm going to sort of pass on this one, if you don't mind. But what I will say is there are seasonalities to there are seasonalities to demand of our product, right? Natural seasonalities. Like for example, personal loans, the demand tends to go down during roughly this time of year because people have filled out their taxes and a lot of people are getting tax returns back. And so timing does come into play of the year when it comes to demand. No problem. Happy to hear any other questions if you got them. Talking about explainability, is SHAP good for that? Yeah, I would say that SHAP or Shapley values are sort of the state of the art when it comes to localized explainability of models. It's more complex than just a single feature explainability, right? Because when we come to explain our models and give adverse action notices, there are lots of interactions and we have to take them into account. So it might not just be one variable, it might be a class of variables. So there's an added complexity with coming up with good reasons that are actionable for borrowers who get declined. Yeah. And I'll point out that Catherine is here. She's one of our recruiters. She gave a link to um, uh, our no action letter if you're interested in the chat. All right. Cool. All right. Well, looks like folks are out of questions. Last chances. Thanks again. It was a pleasure. I hope you found it useful, and it was nice to meet everybody.
Thank you.
Yeah.
Thank you.